I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule, proprietor at Rule Investment Media. Thank you so much for joining me once again. It's always great to see you.
My pleasure, Charlotte. Thanks for having me back.
Of course. So, since we're here at the New Orleans Investment Conference, I wondered if we could start with an easy question on sentiment. I know it's a little bit early, but we're on day 1.5 at this point. So, how's it looking to you?
I think the sentiment here is misleadingly bullish in the sense that this conference has gone on, unlike many other conferences, for 50 years. There's a coterie, a core of investors here, 100 or 150 of them, that have been coming for 20 years or more. So the type of volatility that we're seeing in this market, the fact that people aren't getting immediate gratification, affects audiences that are less experienced more grievously. This particular audience, this isn't their first period of volatility. This isn't their first period of disappointment. So there's a sanguine sense here that is absent many other conferences.
Yeah, I would agree. I was in the presentation hall yesterday, and I did find it actually quite lively. So moving on from that, we have some data points that came out recently this week. We got CPI this morning, new numbers. Also, we saw Fed minutes this week. So we should probably talk about how those things inform where the Fed may be going next.
I think the Fed will continue to raise interest rates to the extent that they can get away with it. I think the Fed is interested in the mythology, the narrative of fighting inflation. I think what the Fed needs to do from a policy perspective is get interest rates high enough that they can cut them if they need to. It's very difficult to effectively cut rates below zero. And I think that Powell is familiar with that. I think on balance, although I don't believe in the existence of the Fed, I think Powell is doing a reasonably good job with the constraints under which he operates. And I hope that there's enough economic strength that although it's against my own interest, I think it's in the country's interest to see interest rates higher.
Right. And so I wondered if we could talk about just general sentiment toward the Fed right now, because I think in this bubble here, we know how people feel. We know that they think the Fed is going to have to turn around at some point, probably sooner than later. But I don't really know if that's the general consensus.
I think my belief is that the Fed will blink and turn it around. I think that if you get outside of my circle, if you get to more conventional Wall Street, and certainly if you get to conventional Main Street, they all have been trained over 40 years to believe that the Fed has their back. They tend to believe that even the political classes have their best interests at heart. I don't happen to agree with that, but I think that there's still a reasonable amount of confidence in the American financial system among the American people. My personal belief is that that's somewhat misplaced, but you asked me a question about broad sentiment, not personal sentiment.
No, exactly. And that's kind of the distinction that I wanted to make here, just so we don't get, stuck in our little bubble here. Right. So thinking more about the Fed, so we have a strong dollar. We've talked about that before. And you've explained to us, and many people I think are on the same page, that it's not that the dollar is strong, it's that the other currencies are weaker. So I keep hearing that when the Fed turns around, then that weakens the dollar. On the flip side, though, I wondered, can we see other currencies strengthen coming from that angle?
If you give me the use of the word could,
yeah.
I can sell you almost everything. I don't think it is probable that happens. When I look at the challenges that confront the United States relative to the challenges that confront, as an example, the European Economic Community, or Britain ex-Europe, or Japan, or China. While our challenges are real, they seem to me somewhat less extreme than the challenges that are being faced in other places. I love Doug Casey's summary, saying that the dollar is the prettiest mare at the slaughterhouse, relatively attractive rather than absolutely attractive. And I concur with that completely.
Okay, and so we're also hearing lately how the dollar is very strong. This is impacting other countries around the world, right? Does the Fed have a responsibility to think about that impact?
Do they have a responsibility? Yes. Do they feel it? No. I think the Fed serves the interests of the U.S. political class and the United States financial services community. The idea that the rest of the world is borrowed in dollars and is facing a situation where it's increasingly difficult for them to pay us back is not something that is of concern to the Fed as much as the US election cycle is.
Right, and we should also touch on the elections because we are coming up on midterm elections. And what are you seeing there? I've heard some mixed opinions on what that could mean for the Fed and for the markets.
Your audience will hate me, but I think it's a contest between dumb and dumber, and I think they're interchangeable. Uh, the idea that either the Democrats or the Republicans would do a good thing for the country seems to me to be a thesis that's disproven by experience. I think there'll be a lot of sound around the midterm elections, but I don't see any substantive change in policy that would affect me. Uh, there may be certain issues where a Democratic controlled Congress would react differently than a Republican Congress. But I don't see as an example that either party would stop manipulating interest rates, would allow a free market to come to money. The issues that are important to me, individual liberty, um, I don't see that in the offing with either party. The country is extremely partisan. And I think if you saw a Republican majority in Congress, that you would see a stock market rally. There's a lot of cash on the sidelines. And that cash believes that a Republican administration would be more business friendly. So, as an example, if you're a share market investor, you might see at the very least a relief rally in the face of a Republican administration, not administration, but a Republican controlled Congress.
Okay, so we're going to wrap up our Fed discussion, hopefully, but I have one more question on that note to ask you. And we recently had Ben Bernanke and his Nobel Prize, along with a couple of other people, and I thought it would be fun to get your take on that and what it tells us that he's won this prize.
Well, it tells us the message that the political class, and in some sense the voters, want to believe. Bernanke was the interventionist in chief. Bernanke had no interest in allowing the American people to make their own investment and credit decisions. Think about what a negative real interest rate is. What a negative real interest rate is a political policy that favors spenders over savers. You don't grow an economy by spending your seed corn, but that's what he encouraged them to do. And that made him extremely popular. The reason for that, of course, is that there are more spenders than savers in society. And if you're going to disadvantage the saving class to the advantage of the spending class, while it will be long-term deleterious to everybody, in the near term it'll be very popular among spenders.
Okay, so moving on, I want to touch quickly on gold, and I imagine that it hasn't really. Your idea probably hasn't changed since the last time we talked. You like it when it's cheap. Mm-hmm. Gold is currently, I think the last time I checked, below 1,700.
Yep.
So is it still the same story for you on gold?
Yeah, I like it better now because gold is in a bull market in every currency in the world except the US dollar. So investors around the world are having a very different experience with gold and a different relationship with gold. If you're a Chinese investor, if you're a Japanese investor, if you're a Swiss investor, if you're a European investor, a British investor, an Indian, and you're in gold, you're having a good time. If you're an Argentine and you've seen the value of your currency fall by 80% and you held gold, you are thanking your lucky stars that you held gold. Gold is an investment pariah for 23% of the world's GDP, which is to say Americans. And if Americans are unconcerned about the aggregate national debt, as they should be, if they're concerned about negative real interest rates, as they should be, if they're concerned about the plurality of government expenditures over government income, which they should be, then I think investors need to be attracted to gold and they need to be grateful that the price is low enough that it's affordable.
Okay, so yeah, that's I think about the same as we left it. So we're consistent. Moving on now to, I want to ask you about this energy crisis that we have brewing in Europe. And, we're smiling, but it's not a very fun question. And what I am wondering is, I think over here in North America, we're a little bit disconnected from that. So how worried should we be?
We should be very worried. You and I talked about this a couple interviews ago. You take Germany as an example. And the Germans decide to rely in their energy future on solar. It's in the north. The sun doesn't shine. The weather's lousy. The idea that you run one of the largest uh, energy economies in the world on an unreliable source of energy for political narrative says a lot about the way we as a species have been conditioned to act in the last 40 years. We have decided to impose narratives in the face of physics and mathematics. So what they're experiencing in Europe really is a return of reality. They, for political reasons, decided to rely on the Russians for natural gas, and then a geopolitical event happened. Germany decided to decommission its nuclear fleet, so now their green goals are blown to smithereens by burning coal. This is the triumph of reality over expectation. And we mustn't be complacent in North America either. We are blessed to have a better energy infrastructure in the United States. We're blessed to have a better grid in the United States. We're blessed to have ample resources of our own and access, in many cases, to Canadian resources. We are truly blessed, but we are still pursuing political policies that are not in our own best interest. And we need to recognize that as there are more people on Earth and as the living standards rise, that we're going to compete with more and more societies, not just Europe, for natural resources. People all the way around the world, Charlotte, want to live like you do, and that requires resources. And as these people get more money, they're going to be able to compete more.
Yeah, and well, you've made this point to us before, and you take, I think, a broader view of energy investing than a lot of people that I talk to, because I speak to people who like only uranium, only oil and gas.
Right.
And we've talked before about both of those things. We've talked about coal as well. And so I'm wondering right now, if you were to rank opportunities in the energy sector, how would you do that? And of course, there's also the clean variations.
Depends on who the investor is.
Okay.
If the investor is willing to take risk and willing to be speculative, that investor needs to be in the uranium space. There's just no ifs, ands, or buts about it. This isn't a theme for 3 years from now. This is a theme for now. But it's speculative. There could be political challenges. There could be an accident in a nuclear power plant that would set that industry back 20 years. So things can go wrong. The probability is not just that things will go right. The probability is that things are going to go very right. And it's not going to happen 4 years from now. It's going to happen in 2023, I think. Investors, people who are interested in probabilistic high rates of return, internal rates of return, need to stick with oil and gas. The political class wants you and I to ride bicycles or use Teslas or something. In fact, about 550 of them flew private jets to Davos to tell us to drive less. This isn't tenable. My suspicion is that peak oil demand occurs about 2045. The political class, your prime minister, my president, wants to make oil and gas assets stranded assets in 2030. But they didn't talk to us. They didn't talk about what we want. They didn't talk about what energy bills we thought were appropriate. So I think investors need to stay in the oil and gas business. Investors who have a real sense of humor for political risk, might continue to stick with the coal business. As you know, I was a reasonable speculator in coal a couple of years ago, succeeded beyond my wildest dreams. I've sold half my position because I think it's so politically unpopular that now that it's popular among investors, I should take some money off the table. But I got to tell you too, the subsidies that are available for people in wind and solar mean that the right class of investors need to look at those. Even if they aren't necessarily economically viable, they're very politically viable. And monetizing the stupidity of the electorate is a time-honored way to make money.
Okay, so really, it's kind of sounding like something for everybody in energy. It's so very interesting. So you're mentioning how, you've sold some coal. I wondered if you could give us kind of a portfolio breakdown, and we could look at that a couple of ways, maybe by sector, by size of company. Would you be able to give an overview there?
Yes and no. No in the sense that breakdown changes person to person to person. What's acceptable to me as a fairly experienced, fat old bald rich guy is very different than what's going to be suitable for a younger person with more limited means, as an example. I I think that the centerpiece of every investor is liquidity. I've told you this for years. Even though the purchasing power of your savings goes down in cash, you have to have cash anyway, because cash will give you the tools and the courage to take advantage of bad circumstances, and bad circumstances will happen. So start with liquidity. By the way, gold is liquidity. It's volatile liquidity, but it's good liquidity. Own gold. Own gold because it's social catastrophe insurance. It does well when the rest of your portfolio, let's be polite, doesn't do well. If you are an investor, not just a saver, an investor, own the big gold stocks. The big gold stocks are the cheapest, if your measure of cheap is net present value relative to enterprise value, than they've been in my career. They're the cheapest they've been in a relative sense in 49 years. So if you're an investor, own the gold stocks. If you are beyond an investor like me, a speculator, now is the time to begin selectively coming back in the juniors. 3 years ago, Charlotte, I said, don't waste your time on the juniors. The big ones are so cheap, you don't need to take the risk. But the small ones have fallen by 60 or 70%. So that objection is no longer valid. If you're a speculator and you're not in the uranium business, I've done everything but call your broker for you. And if you give me the number, I'll do that for you. If you're a speculator, there are probably 13 viable names in the uranium space. The one everybody needs to know is Cameco. Canadian, so no political risk, well run, lots of reserves and resources, a decent balance sheet, a good income statement. When the generalist money comes into the uranium space, it's going to come into Cameco first.
Okay, and let's take a quick sidebar into Cameco, because we did have the big news this week that we should probably get your thoughts on.
Yeah.
I have heard a lot of excitement about it. How do you feel about it?
It says wonderful things for the uranium industry, and I think it's potentially a great transaction. Cameco partnering with Brookfield means that Cameco will have the ability, the access to capital, if they want to actually build nuclear power plants themselves, to sell watts as opposed to uranium.
Yeah.
The risk from my point of view is that Cameco is getting into a business it doesn't know or understand. In my own experience, when I got into businesses I didn't know or understand, occasionally I got spanked. I'm prepared to believe that the CEO of Cameco is much smarter than I. And I hope he is smart enough to simultaneously run Cameco, which is his day job, and integrate this technology company into what he's doing. I'm afraid.
Okay. Okay, so we're getting toward the end here. So I know that you don't really like to be a doom and gloom kind of person, but it seems like every time we talk, we do get a little bit doom and gloomy. You've also told us, precious metals help you sleep better at night. So I guess the question, is there anything keeping you up right now, despite your precious metals?
Yeah, lots. Not about my precious metals.
No.
I actually hope my precious metals go down in price. Because they're catastrophe insurance. And I'm old enough not to want to collect on my insurance policy. I don't want the bad thing to happen, I'm going to take life insurance personally, So I hope my precious metals stay cheap. Stuff that makes me nervous. When the interest rate rises, the net present value of income streams go down. So not all, but many of the assets that are in things like Canada Pension Plan, long bonds, are worth less, which means that people's retirements 20 years from now are less secure. And that scares me. Most people haven't saved. They rely on the big thinkers to save for them. And I think there's problems. The problem that you see in disintermediation in London with the long bond, with the gilt, that's really problematic. The big institutions were trying to enhance yields by leveraging long bond purchases, trying to own long-term assets with short-term debt. When the short-term debt becomes unavailable, not pretty. I'm really concerned about corporate junk debt and the fact that corporate junk debt is owned in ETFs. So Moz and Paws, who are yield chasers, own highly liquid instruments, ETFs, that own highly illiquid assets, junk bonds. If something were to happen that would cause people to be concerned about subprime credits, and those Moz and Paws went to liquidate their ETFs, I don't believe that the ETFs could sell the underlying bonds fast enough to fund redemptions. And that scares the hell out of me.
Okay, that's a good list of things that we should worry about. So last question, we're going to end on hopefully what I think is a fun note. we look into the future 5 years from now, if we're looking, let's say, at the resource space, what commodity do you think will have appreciated the most in value?
I don't know. I honestly don't know. I think there's a probability that in the next 5 years we run into a recession. I'm not saying we're going to, but I think there's a probability. If we don't run into a recession, the price of every commodity will be markedly higher because we are running into a supply cliff. We're going to be producing less oil. We're going to be producing less natural gas. We're going to be producing much less copper, less nickel, less phosphate. You can have lower production if you have lower consumption without having a price rise. So a recession could offset many of the deleterious, the scary impacts of a supply cliff. If we don't have a recession, people will be surprised with the level of commodity prices. Very surprised.
Okay. I think we can wrap it up there. Thank you, as usual, for coming by to talk. Always great to hear from you.
Pleasure. Thank you.
Great. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule.